Hey there, and welcome to 20 Minutes of Clarity. I'm your host, Andy Merchant, and I have my co-host, who I'm taking his seat again this time, Jason Noble, with me today. And we're gonna jump into some fun extended conversation from last week. If those that jumped in last week or tuned in, we talked about the importance of having a savings plan. And I hope that everybody took our little nugget of advice, had that conversation around the table around what that retirement vision is. I think that could be some fun conversation. Jason, I know you had a great story with Rachel, and I had one with Ange, and I'm excited to have that in our Q&A at a future kind of recap. But today, what came out of ours and what we want to focus on today is on the retirement series is the focus of how do you best optimize or the different type of retirement vehicles that you can now put your long-term savings in that will help you implement that retirement savings plan. So such an important conversation because I think that we oftentimes are kind of taught one or the features of them, and we're not really here to talk about the benefits of the account. So Jason, I'm excited for this one. Are you excited?
Yeah, let's get into it. I mean, so like retirement types of accounts, right? Well, this is pretty straightforward, but I will put it in like three different buckets. So you have the pre-tax bucket, you have the tax-free bucket, and then you have the taxable bucket, right? So let me give some definitions now to what I was talking about. The pre-tax bucket, think about like your 401k, your traditional 401k, your traditional IRA, your rollover IRA. So you're able to put that money in. Most times, there's some exclusions to this, but in most cases, you're able to put that money in and get a tax break while you put the money in. The money grows tax deferred. And then when you take the money out of this bucket, right, you got to pay ordinary income taxes. You can, in certain situations, pay a 10% penalty as well, depending on when you take it out. So you have to be aware of those rules. Today is not the time for us to talk about that, though. Then on the tax-free bucket, we'll think about like the Roth 401k, the Roth 403b, the Roth IRA. When you put the money in, you've already paid taxes on that money. Then the money grows tax deferred, and then after you meet certain criteria and you make the distributions, it's tax-free withdrawal. Hence why it's in that bucket. Okay, and then last but not least, you have the taxable bucket. Well, the taxable bucket will be like a joint brokerage account. A trust account, individual with the TOD, transfer on death designation type of account. Now, when you put the money in there, you've already paid taxes. But when you buy the investment, it starts what's called the basis. So determining if you pay a short-term capital gain or a short-term capital loss, right? There's long-term capital gains and long-term losses. But how that is taxed is going to be depending on what is going on with the underlying investments. And then that could be a tax benefit to you if you know how to construct your strategy the right way in order to take advantage of the tax code laws that we have in our country. But that we do call that taxable is in that bucket because if you buy and sell something and it's for a gain and you don't do anything to offset that, you will be paying taxes, either ordinary income or capital gains tax, depending on what you bought and when you sold it and things of that nature. So be aware of those rules. Andy, now, we're talking about buckets on the three different buckets. Is there anything that you want to add on that part of it?
No, I think, when you start to think about this and you're planning for retirement and you're going out, the reality is, I think where the challenge falls here is that, most of you that are listening or most investors that are out there are saving are just really familiar with the 401k or the pre-tax or tax deferred bucket, right? The traditional mindset for those that are listening out there and viewing this today is we go to work, we save, we get a match, we put it into our long-term bucket called the 401k retirement, and we hope that when we retire, we're in a lower tax bracket, right? And so having an understanding of the importance of building out your buckets within a tax-free component, and I'll hit a point on that, Jason, to add to your question. The tax deferred is important. We know that there's deferral, you're kind of hedging, and then the brokerage, or what I call the tax managed account, is where you have a little bit more control of your money. Now, traditionally, that bucket, that last bucket, is the one that gets filled with the amount of lease for long term. Everybody's like, oh, that's my money for tomorrow. That's my bank money. But then they realize that that if you're in a higher net worth bracket, that's your most tax efficient bucket for transfer, right? If you're in a higher earning today, you have to go back to your retirement planning goals and say, am I going to be in a lower retirement bucket tomorrow? Because if not, maybe the tax deferred from the traditional standpoint isn't the most optimal bucket for you, right? So we have to ask those questions. Inside of those, if you're like, I can't save money, I'm terrible, at doing this, I have no self-discipline. Well, you know what? The 401k is the best bucket. Why? Because once it's in there, it's in there. And the only way to get it out is by breaking some rules and paying some taxes and penalties. So if you can't save and you need a forced saving, that's the way to go. But the reason I saved, again, tax-free for the last part, there's a lot of different ways to get tax-free money that we've covered in previous episodes and discussions. And if you need to go back and revisit them, you can always go to clearpicturefinancial.com. There's all of our past podcast conversations and resources. But the one I'm focusing on right now, why it's so important, is that what we haven't had in a while, Jason, is we haven't had this tax-free equivalent yield difference. A mouthful of word and not for the depth of conversation. But the important part about retirement planning and that bucket is that if you could have a good amount of your money in your retirement income coming from a tax-free bucket, you don't need as much of the nest egg that you would have to have in the other two buckets. So the importance of being able to forecast what your retirement incomes and having the right amount of money in each bucket, I think is so important. And we have to break the mold that the traditional tax deferred route is the only route. And we have to start looking at holistically the three different types of buckets in order to get to your retirement objectives.
Yeah. You have $1 million in your 401k, your traditional 401k, and let's say this state that you live in and federal and state taxes, let's just say is 20%. Well, you really don't have $1 million in your account.
Correct.
Right. And but if you have that in a Roth, well, then yeah, you do, as long as you met the aging rules that are involved in that. But what about $1 million in a taxable account? Well, yeah, unless you liquidate the entire account at once, at most you'd be looking at a 20% capital gains tax at the time of this conversation, right?
Mm-hmm.
You'd most likely falling in between 0 to 15%. Let me explain this. This is a unique scenario and situation, but I was talking with this couple, and I was going, hey, for your first 4 years of retirement, I'm going to do tax loss harvesting based off of the investments that you have in your strategy and have that supplement your income needs. By me doing that, it's going to lower your modified adjusted gross income, so you're going to get a premium tax credit on your healthcare. Not only that, this money that is provided to you is going to come out tax-free. You're not going to pay any taxes on it. And so we then kick that over to the accountant to make sure that I did my math right and looked at all the calculations the right way. Because we don't give tax advice, right, Andy? No,
That's
we
right.
just give
Yeah.
tax facts, and we'll work with your partners. And the accountant came back and verified everything I said was accurate and was going to be in line with the plan. And so now they're coming in just shy of $90,000 a year for the foreseeable future, no taxes, and having low impact on their healthcare. The advisor that they were working with before they came in and met with me was telling them to take a distribution out of their 401k, and if they were to do that, their healthcare premiums were going to be a lot higher. They were not going to get the premium tax credit. They were going to have to pay the full amount, and it was going to create more tax drag on their portfolio. So because they had this bucket, this taxable bucket that we were talking about with the joint brokerage account, we were able to utilize that and really put them in a position to retire on their terms, but not get raked over the coals with taxes and healthcare costs.
Mm-hmm. Yeah. So on that, let me throw an exercise out for those that are watching and viewing today. Look at your net worth statement, right? We talked about that in a previous one, but go look at your total balance of your investment accounts. And all you have to do is break these three buckets down, right? Tax-free, tax deferred, and after tax or tax managed accounts, cash as well. And then go down below and write the totals of each of those buckets from your account. So if you have a Roth, put in the Roth bucket. If you have cash value life insurance, put it under the tax free. If you have a traditional IRA or a Roth, or a 401k, 403b, anything that's got tax deferred through your employer that's non-Roth, put that value in there. And then your bank and other cash, put that below. Look at that and start to say, is there kind of a dislocation, or is there a concentration in one bucket over the other? Because if you have too much in the middle bucket, being the tax deferred, you might run into the scenario that Jason just referred to. You may get to a point where if you decide that your retirement plan is to retire in a different state, there are different income rules in states. And if all your income and your cash flow in retirement, you have to ask, how much taxes am I paying? That's going to make it to where you're always going to have to worry, right? Did I do the right decision? Did I save the most? You get to a point, it gets hard once you've actually landed your destination to start to make changes in retirement versus before retirement. So start off there. Take your assets, sit down at the table, write down those numbers. That's a simple exercise that you can do. Our team does this all the time for our clients. We always analyze it, and we start the baseline foundation there. Now, I want to take this. A lot of people may, this whole podcast, right, Jason, is about simplifying the complexity of financial planning. And what I realize is the reason financial planning and financial topics are so complex is because most people don't spend all the time day to day like we do in the jargon, in the word, in the practice, in the art. And so sometimes I think we've made this focus of shifting it to maybe a more everyday environment. And I know we talked a little bit beforehand. We're going to see if we can make this sound easy to understand. We may confuse it, but you know what? That's the point of live podcast. But I want everybody that's listening and viewing this today is just take a step back from the financial world, put yourself on a back seat or in your backyard, and you're building a birdhouse with your child or your grandchild, right? It's all fun. You can't build that birdhouse. And that birdhouse is going to be, your cash flow pool in retirement. And Jason, we're going to have some fun on this. But what you have to do to build the birdhouse, and we're just going to stay to one concept, outside of design, outside the fun, you have to fasten it, right? It has to be together. It's not a birdhouse. It's just a bunch of wood right out there. Now, there's multiple ways that you can construct that birdhouse, right? You can use a screwdriver and screws, right? That'll connect two pieces of wood together. You can nail it, right? Using an air nailer or a hand nailer, depending on how much fun you want to have. I'll tell you, I was at Home Depot this weekend, and I walked down that aisle and bang, bang, bang. I'd rather use an nail nailer all day. And then the fast thing is you can glue it. Now, for all of our craftsmen and craftswomen out there, you're probably going, oh, there's a whole different way of doing things. But what I want everybody to do is picture those three buckets that we just talked about in those three different areas. So picture your tax-free accounts as a screwdriver. Now, why did I pick a screwdriver? It's a way to fasten your future retirement cash flow, but it's got flexibility on the way. You can screw something in and you can unscrew it and move it and rescrew it again, right? That same screw and screwdriver will get you to that point. You can do it at any pace you want, which is why it's got flexibility. Now, on the other hand, if you were to nail that piece of wood together using an nail nail or whatever else, how many times, Jason, have you built something with a nail and then pulled the nail out and said, crap, I didn't do it right, and used that same nail again? No, you threw that one away, you started all over again, right? I look at that as it's strong, it's easier, right? You don't have to twist, your arm doesn't get tired, you just go pop, right? Or hammer a few times. It's easy, so it's your tax deferred account. It gets you there in the most efficient way, probably, than any of the other methods of putting stuff together. But once you put it there, it's really hard to change the rules, and you're going to have to play with the rules if you take it out. Okay. My final one is glue. Like, glue will fasten it. Will it hold? I don't know. Right. So if you think about that as like an after-tax account, right? You might have all the good intention to have that piece of wood stick, and you're going to put some glue on it, just like you're going to have all the intention to take some after-tax money and save it for a long period of time. But what you can do, if you don't like it, you can just peel the wood off and move on and redo it. And there's very little impact. Just like putting money in an after-tax account, it's a lot easier to get to. You could disrupt the plan, but it's pliable in its movement. So I don't know if I took us down a more confusing on simplifying this tactic, but I want people to think, and I want your thoughts, Jason, on this. If you're going to fasten your future income stream, think about there's multiple ways to fasten the same item, but are you able to do it in the way that has the most flexibility now, the consistency that you need to do it tomorrow, but then the pliability and the flexibility that life happens. We live in a dynamic world. Things will change. Sometimes you need to glue it. Sometimes you need to screw it. And sometimes you just got to nail it.
Well,
Construction site.
Yeah, we're taking people to construction sites. We're talking about buckets and fasteners and yeah. So I mean, but one thing I appreciate, Andy, though, is you and I are always looking at ways to explain the concepts of financial information and financial planning in a way that is not jargon riddled, you know. So, bear with us, right? We're trying what we can do to bring financial literacy and financial information and financial concepts to more and more people so that people can make better informed financial decisions. So, we're talking about retirement planning at the end of the day. And one of the things about retirement planning is making sure that you have a plan and you got to have an actual plan for retirement planning, right? Well, if you're going to build a birdhouse, I would imagine that you probably have an idea of like how you want to put it together, how you want the final thing to look.
Yes. Yep.
Right. And it's either you come up with your own diagram or you have it provided to you so you know what pieces have to go together. Right. And now if you're going to do this from scratch all on your own, well, then you also have to measure out the wood, make sure you can cut the wood, right?
Yep.
And have the angles that you want to have for that wood so that it's coming together and it's coming together nicely for the birdhouse, right? I mean, it's just not, you just don't go and get like a whole bunch of wood, start cutting it willy-nilly, and then start using any fasteners that you think you should be using because you just want to do it that way and think like it's going to all work out. No, life doesn't happen that way, right? And so going to Andy's analogy and metaphor, I don't think I can add anything to that, right? I think you said it very well.
I said it as well as you're willing to agree with. So,
but
yeah.
So one thing I thought was interesting is about like the screwdriver being like the Roth, where you could be able to take that money, you could screw it in, and if you want to change it, you could unscrew it and then use that somewhere else, right? And how the nail's a little bit more permanent. What I liked is that you were able to draw in some of the restrictions that these different types of accounts have, and with those restrictions, it could create financial situations in the future if you don't take those into account as you're building out your retirement birdhouse, right? You gotta have that plan in place and making sure, like, well, like for instance, I'm just thinking if I was building that birdhouse with my son and daughter, my daughter would want to change the design of the birdhouse 3 times in the middle of building it out. So that tells me we're going to have a little bit more glue, right, to adjust for that flexibility. Now, my son, he's going to want to do the screwdriver because he finds that to be really fun to screw those things in. And I like the hammer, right?
Just be done with it.
But here's the thing. Most 401ks, most employers, they tell their employees to do the 401k, the pre-tax 401k, because when the only tool that you have is a hammer, every single problem you find is going to be a nail, right? And you're able to fix it with just a hammer. That is not the reality. This has to be customized specifically to your financial plan. And the last thing I'm going to share with you before we go into our call to action and what we want you to do next with this information is you have to make sure that you understand that things change, right? The wood that you used 30 years ago to build your first birdhouse is not the same wood that's the same treatments that we have today. There's like new codes, even in birdhouses. There's new codes and new laws, right? Right? You have to be willing to make those adjustments. And so understand that you start the birdhouse with the tools that you have available to you. But as you can imagine, the tools that we have, Andy and I have in our tool belt, is pretty sophisticated when it comes to making sure you have the right birdhouse for your retirement. Andy, would you want to take us home?
No, I love that ending. No, I think I hope this resonated with everyone today. So we look forward to, if we recap real quick, the main thing to take away is that take the exercise, sit at your table, identify your birdhouse or your assets within your birdhouse. Figure out which ones are the screws, the nails, and the glue. Right. We'd love to have a conversation with you if you have questions. It's part of our Clear Picture Wealth program. Everything starts with 30-minute conversations, and Jason and I and our team is ready to have that conversation, right, to helping you understand your birdhouse. So we look forward to you. Make sure you check us out there. The other thing I want to preview everybody on is in 2 weeks from now. We're going to start feeding in, and we're going to highlight the questions that you have on cash flow as well as retirement planning at this point. So if you got questions, go to clearpicturefinancial.com, shoot us over your message, connect with Jason and I on our LinkedIn pages. You can find us at Clear Picture Financial for both of our pages in our markets. We'd love to connect with you. But anyway, I appreciate you guys joining today. Have a great day. Hopefully some birdhouses are in your future.
Thank you.